afternoon. I want to thank everybody for logging in and calling in today in our webinar. We have another special guest with us today who we're going to introduce in just a few moments. But we're going to focus today's webinar on owner financing in real estate investments, and a little nod to the IRA at times as we're doing this today. But we brought a special guest in to talk about why this could definitely be a strategy that either you want to employ if you're not already employing it, or how to make it better and how to run your system better if it's something you're already doing in your investments, whether it's IRA funds that you have at Advanta that you're investing, or whether these are personal money that you're looking. It's kind of more of a broad topic that we're going to talk about today. We talk about owner or seller financing with real estate investments. My name is Scott Maurer. I'm the the Director of Business Development here at Advanta IRA. I've been with the company for a number of years now. Started out doing a lot of the transaction work. In fact, some of my first transactions that I saw and really got the concept of seller financing was from a client who was buying properties at auction, getting properties fixed up, and then in turn selling them to end users. And I did the actual all the transaction paperwork for that, so I was able to see that transaction occur with this client on multiple occasions. But I've spent more of my time the last few years really focused on the business development aspect, teaching classes, teaching webinars, seminars. So I'm excited, obviously, to have our guest on today. We'll introduce here in just a moment. Now, a quick disclaimer. Again, Advanta does not provide legal, tax, or investment advice. Now, in the course of our webinars and our seminars that we hold, we talk about legal issues, we talk about tax issues, and we're certainly talking about investment issues. But we do not advocate for any particular style of investment, any particular terms, et cetera, that you might get involved in. So it is up to you as the individual to do your due diligence. If you need legal or tax advice, we can refer you out to somebody. And if you need investment advice, we can certainly potentially refer you to someone for that too. So the portion of the webinar today, we have our guest on. It's not anything we especially endorse his methods. We just want to provide a platform and just some other great information, I think, for you all that are listening, whether it's live or on the recording, to really take in. Now, we do have the recording live today. If you're listening live and you have questions on the presentation, you have questions either for myself or for our guests, please type those into the chat box on your screen. If you're listening to the recorded version, jot down your question. We'll make sure that you have both my information and our guest's information as well if you want to reach out to us with any questions as we go along. Now, just a little bit about Advanta. For most of you on the call familiar with it, we are a self-directed plan administrator. We work with clients nationwide. We really pride ourselves on the service we provide, the experience, and really the knowledge that we have through all of our staff members, whether it's myself on the business development side or even the account managers that we have for each individual client to give you the best service and the best information for your self-directed IRA needs. We've been in the business since 2003. We've combined 20-plus years of experience with all our principals that are involved. And we currently hold, actually the number is a little outdated, that we're close to $1 billion in assets that we hold in management for all of our clients and their self-directed accounts. And again, I mentioned the account managers that we have for all of our clients. That's a concierge-style system where you are assigned to one particular person. If you have an account with Advanta, you have one point of contact with anything you need regarding your accounts. It's not a matter of you calling into a 100 number, getting the next available representative. Part of today's webinar is our commitment to education, providing webinars, seminars, networking events, all on a variety of topics, really to educate individuals on the basics of self-directed IRAs or your particular investment that you're looking to make. So we have these events either live, like you're listening to today. We have them on demand at our Learning Center at AdvantaIRA.com. We also have a YouTube page that houses all of the recordings of our seminars, or at least our webinars as well. Now, the types of assets people invest in with their IRA account, real estate is probably the most common asset that we have at Advanta, and that takes a number of forms, whether that's someone investing into rental properties, whether it's commercial or residential, people investing into rehabs or flips, raw land, condos. Again, if it has a deed, your IRA can own it. But aside from the actual ownership of real estate, we see people do a lot of mortgage loans. Whether it's your IRA originating that a loan to a person who's buying a property, that's one way individuals invest in mortgage notes. What we're going to talk about today with our guest is really the seller financed option. And we think, and I mentioned I had a client that has done this. Here's a little bit of what his process looked like in using his IRA to purchase property and end up at the end of the day holding a seller finance note within his account. So in this case study, John has a regular IRA account, wants to buy real estate, or is interested in real estate, knows that he could buy rentals and rehabs, could lend money to third parties, etc. But John transfers the money from his brokerage account to Advanta so he can get that control. But he really wants to have the income, monthly income, back to his account without the headaches of landlording. John knows that Advanta, we have a self-directed IRA. The income that is generated would be deposited back into the IRA. Any expense related to those investments would be held in the account as well, and Advanta does pay those bills. So how does this look? John wants to buy a property, buy a mortgage loan. It's important when you're buying in an IRA that the ownership is titled in the name of the IRA. If you're doing lending in your IRA, you need to make sure that you are complying with local or federal laws on lending, whether there's usury, Dodd-Frank concerns, other rules that you need to make sure you're aware of. The loan terms, the interest, maturity date on a loan, how much you want for a down payment, all those terms that go into making a loan with your IRA account is decided between you as the IRA lender and your borrower. And that borrower must be an unrelated third party. Ultimately, the borrower is making their monthly mortgage payments back to your IRA account. So what did this look like? I said I mentioned a client. He actually has done this over a dozen times within his IRA. But he would buy property at auction. In this example, John buys the property at auction for $75,000. His IRA takes title to that real estate. So his IRA is on the title of the deed, and we assisted in the closing process and making sure that that happened. But John ended up, instead of keeping this property as a long-term rental, he had his IRA pay for the fix-up, pay for the repairs, get that property ready to sell, and he was looking to sell to end buyers, actually sell to people who wanted to live and make that their residence, their home, wasn't selling to a fellow investor. So his IRA would sell the property, in this case to Bill and Susie. They agreed to the purchase, so he got the property at a deal at an auction, fixed it up a little bit, sold it for a higher price. Bill and Susie would make a down payment of $10,000. So John's IRA at least has some equity in the property, knows that that they have some equity in the property, they have some skin in the game. And Bill and Susie, in addition to giving him $10,000 down, signed a note or mortgage for $100,000, promising to pay 10% interest over 15 years back into John's IRA account. So John's IRA, rather than dealing with the tenants, dealing with toilets, termites, all those lovely things that go along with owning real estate as a rental property, was able instead to use his IRA to acquire property, but in turn flip it, in a sense, for just paper, holding real estate and mortgage notes that are simply returning that monthly payment to his IRA account. So again, this is an example of what we've seen people do within their self-directed IRA account. But we have a guest on today who's going to talk, again, more about the owner financing process in general, again, whether it's IRA, non-IRA. So we're really happy to have Mitch Stephen come on today and talk to us about this. Mitch is an expert in owner financing. He's going to share some case studies with you, show some other just good things to know, and he's got a couple of free offers for you too that he's going to share. Mitch, are you there?
I'm there. Thank you very much for having me, Scott.
All right, great, Mitch. Well, I'm going to turn over the presentation to you. And again, anyone who has questions, type those into the chat box on the screen. We'll make sure we try to get to those. As we go along, if we run out of time, we'll put you in touch with Mitch or myself afterwards to answer those. But Mitch, the floor is yours.
Hey, well, Scott, I think it'd be real interesting if you took that transaction that your friend did with Bill and Susie Homeowner and you figured out what the effective rate of return was on this man's money.
Oh, yeah, well, we'll definitely figure that out the next time we do the presentation.
I think it'd be pretty interesting. I was waiting for that next slide, like, geez, that's got to be a heck of a rate of return.
Yes.
Okay, so I have to go through the same disclaimers that Scott went through for the obvious reasons. I'm not an attorney. I'm not a CPA. You got to check out everything I'm saying to make sure that it applies in your state with your property code, with Dodd-Frank. And, it's your responsibility to vet the thing. I think I've done a good job at it, but you need to verify for yourself, So that's what that slide's all about. Now, I've been in San Antonio, Texas for about since 1973, and that's my 3-story building there in the back, and I've been flipping homes, or I don't even know that what I do is technically flipping, because I still own the home, but I don't. I mean, I still own the income stream, but I don't own the house. So technically it's flipping, but it's a little different twist. Generally, flipping is you buy it, you fix it up, you sell it, you're out, you're done, it's over. I got a little twist on that. I'm the author of the book series, My Life in 1,000 Houses. There's 3 books in that series: Failing Forward to Financial Freedom, 200-plus Ways to Find Bargain Properties, and The Art of Owner Financing. So there's the 3 books, the books covers right here. This and $7 will buy you a cup of coffee at Starbucks, all right? So I don't really, I'll explain to you one day how I got to this place in my life, but you could read it for yourself if you want to. You can get the first 100 pages of my first book, Failing Forward to Financial Freedom, at this URL, this website, 1000houses.com/Advanta. That's 1,000 houses. That's 1000houses.com/Advanta. And, it's pretty self-explanatory. I want to get over here to, I got a ton of free stuff, at 1000houses.com/menu. There's some of the free stuff, free Q&A calls, 100 pages of my book. I got a webinar on this for about an hour and a half on it, covers some of the same ground as we're going to cover today, but it's longer, of course. I have a podcast, REInvestorSummit.com, and I've interviewed over 250 people now. This slide is a little old. I also am the owner of a software company called livecom.com that helps us sell these houses. Just watch the videos at that site and you'll see, but it's an amazing software. Right now I have 6,143 people that have called for owner-financed homes, and I can text them at will for less than 2 cents per person anytime I have a new house come up, and I can do it all from my phone. It's an incredible system. Check it out. One last thing, if you're really involved in seller financing and you want to protect the industry, make sure you check out the Texas 100, the Texas100.org, and see how we're fighting to preserve our creative real estate industry and how we're learning to have a voice at the state and federal level so that, let me put it this way. Our industry is on the table, and if we don't show up at the table, we'll be on the menu. So we have to have a voice, state and federal, and to keep reasonable and great laws for our business.
Yeah, Mitch, I can add on that. We had in here in Florida right now, there's a couple of bills that are up for signature for the governor that deal with private lending and deal with this industry. So I would echo that to stay informed, because people pass laws, they don't either know the effect it's going to have on you, or maybe they do and they're trying to slide it through. So staying informed is certainly important with your legislators.
Yeah, if you go to the sellerfinancecoalition.org, or I have a personal movement, and it's called the Texas100.org. I would love for someone to mimic it in Florida, but I'm getting 100 Texans to commit to paying $1,000 a year for 3 years at least consecutive, and I'm starting out by getting 20 Texans to get 4. And we're going to have our lobbyists representing, and this is at a federal level. So anyways, you can go to Texas100.org, and if you want to do it for your state, I'm looking for someone to mimic what I'm doing in any state, because we need to have a voice, because this industry could go away for us if we're not careful. So you'll get a kick out of this, Scott. I did not invent real estate, and I did not invent owner financing, and I do not think I'm God's gift to real estate, and I'm just here to help people shorten the path. It took me 22 years to figure out. And I should have really been able to do it in a much shorter period of time, but there was just things I didn't know, and there were some things that took me quite a long time to figure out, and I'm going to try to shortcut your path right now.
Yeah, that's why we brought you on to share that with us.
I've made a ton of mistakes. I'd like to say I don't make those mistakes anymore. I need to change this slide, but I don't make them as often. Or every now and then I forget about something and I do it again. I go, oh yeah, that's why I don't do that anymore. But I've done over 1,500 houses in my town since 1996, and I just have a lot of experience. Not all of it good. I've had some really bad experiences, and some I don't want to repeat. So I'll try to keep people from making those mistakes. My life changed dramatically on one day, and I don't remember where or when, but someone defined financial freedom in front of me, and it started a whole chain reactions of small little revelations. The definition was financial freedom happens when your wants and your needs are exceeded by your cash flow. It actually said passive income, when it's exceeded by your passive income, but I don't believe in passivity, and I don't believe anything's passive. If you have $1 billion and you don't watch it, you won't have $1 billion soon. So I changed it. Financial freedom happens when your wants and your needs are exceeded by your cash flow. First revelation was it was mathematical, that I could figure out where my financial freedom was on a chart if I could figure out how much I was spending. And as soon as I got enough coming in to equal $1 more than what I was spending, I was financially independent. Second revelation was, at the time, I needed $4,500 to be financially free. And my second revelation right off the bat was, wow, financial freedom has nothing to do with being rich. I always thought that financial freedom was for the rich people. That was words that rich people used. All I needed to be financially free was $4,501. And that was a long ways from being rich or wealthy. Second thing, boom, I had another revelation. Real quick, I controlled the bar. So in the name of financial freedom, I scuttled about $1,000 a month of things that I didn't need, about $1,000 worth of things that I valued less than my financial freedom. So I got my financial freedom number down to 3,500. And I figured if real wealth was in the cards for Mitch Stephen, that it would happen after I became financially free on the most modest level. And one of the reasons why I came to that conclusion was because the minute I became financially free and my bills and my overhead were paid for automatically every month, from my cash flow, I could stop giving 2,600 hours a year to someone else. And I could start improving Mitch Stephen day after day after day after day, hour after hour, week after week, month after month, year after year. And if being wealthy was in the cards, that's when it would happen, when I did not have to worry about my bills. And I could go out and experiment with anything above and beyond my financial freedom number. And if I lost that money, it was just money at that point. It was just R&D money. If you go out and gamble and lose everything and have to come back and they take your house away from you and your car away from you and your wife divorces you because of the financial stress, that's not a plan. I have it in the book, Failing Forward to Financial Freedom. I didn't know at the time what I was doing, but I was trying to document how I felt like I could go out and fail without going under. And it's called the moat theory. And if you get the first 100 pages free of my book, you can read about the moat theory and see how I planned to go out in this world and fail time after time after time, but never go under until I figured it out. And so all of a sudden, my goals shrank immediately, because the first step was I just got to get a measly $3,500 a month coming to my mailbox. Is that too much to ask out of life in the United States of America, the greatest country in the world, who had given me a great education? I didn't have any college, but I still had a great education, especially compared to most of the world. So that's what all started it. And it was because, you ever heard the saying, the teacher will appear when the student was ready? I think I was ready at this time. I wasn't until I was 36 that I found what I was supposed to do. I tried a lot of businesses, and I failed at a lot of businesses. Always managed to keep my name and my credit intact, but I was constantly trying the new business of the year and constantly failing until this business, because I figured out how to fail forward. I'm not going to talk about this right here. The reason why I landed on real estate and I liked it so much is because it's a tangible asset. I don't think it's going out of style. It has a lot of tax advantages, especially what we're talking about right now by putting people into tax-deferred vehicles. Here's the kicker. You got the average American pays 30% in 32% in income taxes, pays 34% in interest, and I would assume this is bad interest, which means it doesn't make money. And you only have 34% left over to try to make your mark in the world. So we have to start being smart about our taxes, and we have to start learning how to live on pre-tax dollars if we have businesses. You know, my business owns my phone. My business pays for my phone. I don't own it. I don't want to own it. I just want to use it. If you don't know about living on pre-tax dollars, write that down. Study that topic, how to live on pre-tax dollars. One of the great things you're doing right here with Advanta is you're learning how to grow a retirement and postponing taxes out. In some cases, forever. If you have like Roth IRAs, there's different choices. I'm sure Scott can explain all that to you. The other thing I like about real estate is I didn't need college. There was plenty of people out there talking or teaching, and I didn't have to go through a formal education to do this, which was a great thing because I didn't have a college degree and I wasn't going to get one. It wasn't for me. I knew it wasn't for me, and I wasn't going to go that route. So education was readily available for me. A lot of it was free. Some of it cost some money, and some real important parts of it cost a lot of money. But I could earn while I was going to school. I could make money from these theories while I was paying for a higher education from people who had already been successful in this business. They're called mentors or coaches. And there's one thing for sure. You're either going to pay the mentor or the coach, or you're going to pay the street. And believe me, the street is ruthless. It'll charge you way more, and it's very stressful to be on the street and try to figure it out by yourself. So when it comes time for you, make sure you find the right person to mentor you or coach you. It'll save you a lot of time. So this is the rental model that we've been sold. And I'm not chastising rentals. I'm not saying that anyone who does rentals is an idiot. I'm not saying any of that. I'm saying there's two sides to the coin. There's been a lot of millionaires made in the rental business. But I think a lot of the people that are making it in the rental business are able to pay for their investments in full, and they're not getting loans. I can understand how the rental business works when you have no mortgage payment and you're collecting a payment because there's enough money to pay the repairs and pay the maintenance and still make some money. But if you're borrowing, 75, 80, 85, 90% on these houses, and you're clearing $300 or $400 per house, one air conditioner goes out and you've lost your entire, year's worth of potential income on that house. So the traditional methods, borrow from institutions, buy a $100K house for $75K, get a little bit of a discount. I don't consider that much of a discount, but a little bit. You get 10 to 15 rent houses, and you have the tenants pay for them over the years and years. And you spend 10, 15, 20, 25 years getting them all paid off free and clear. And the rents go up, the values of the houses appreciate. You get to write them off depreciation on your taxes, and you live off the cash flow. And then in your later years, you can sell one house a year or one house every 2 years and live a pretty big life, even replacing houses as you go. But this just took too much time for me. I know that there's been a lot of millionaires made this way, but it wasn't for me. Because once upon a time in 1996, I had 25 rentals, and they were killing me. 25, they're supposed to make $300 a month on every house, and I had 25 houses. So I worked for a year at it. Either I was the worst landlord in the world or I don't know, but 25 times 300 a month equaled zero when I got finished paying for all the stuff that broke or got stolen or repairing houses that people left out of, messed up. And I was about to quit for good, and then I gave $10,000 to a mentor. It was my last $10,000. So it's always a lot of money when it's your last $10,000. And it seemed like $100,000, and I was so nervous. And this guy showed me how to owner finance these houses, take a down payment, collect monthly mortgage payments, not rental payments. And all of a sudden, the $7,500 I was supposed to be making as a landlord started coming in and sticking in my bank account as the bank. I was being the bank. I was not the landlord anymore. I was the bank. These people gave me, they gave me $3,000 down a piece on average. This is 20 years ago, and this is relative. These houses were $35,000, $40,000 houses. That was the owner finance price. And so 25 times 3,000 down was $75,000 I had in my bank account from down payments, not refundable rent deposits. This was non-refundable down payment money. It was my money. And that right away changed my life because I'd never seen $75,000 in my bank account ever, nor did I expect to. I didn't even believe in this process at first, but this guy kept telling me this is how I'd solve my problem. Quit being a landlord and be the bank. So I reluctantly went out and didn't even believe in the system and was able to get $3,000 a house. Today, I would be getting $8,000 to $12,000 a house because I'm a believer. I know the market. I know the demands for it, and just believing makes a lot of difference. I also knew in my life that I wouldn't collect 100% of the $7,500 rent. That's one of the reasons I got my overhead down to $3,500. But I wasn't so naive to think that as a landlord that I would collect every dime. So I didn't quit my job until I had $7,500 a month potential income coming in on paper, and I only needed $3,500 to live. So I thought, well, certainly I'll be able to keep $3,500. But as a landlord, I was completely wrong. So I changed. Now the problem with being a landlord,
Mitch, if I can ask you a quick question, just for the people that are listening too. You had 25 rentals. How long did it take you to transition all of those rentals into the mortgages? I don't know if you're going to cover that in a second. I just was curious how long that process took.
Good point. I usually do cover it. It took me about 4 months. I think I might have had a couple of stragglers that ended up taking another 2 months. So by 6 months, I had them all done. But I had the bulk of them done in 60 to 90 days. A lot of, if I had good tenants, they had the money, I just sold it to them. Other ones, I took my vacants. I did my vacants first. I never messed with a good tenant. The good tenants were always last, the really, really, really good ones. And then I would ask them if they wanted to own, and, most of the good ones really did want to own, and they also had the ability to save a little money. It didn't take me very long. And I looked up and I had $75,000 in the bank. I was collecting $7,500 a month. And the renter mentality and the owner mentality were two completely different mentalities. One was tearing my house down and leaving, and the other one was fixing my house up and staying for years. So it was a completely different mentality, and all my phone calls stopped. Now, I did talk about depreciation and appreciation. I want to revisit that, but then something happened, and we're not going to touch on it a lot here, but shortly after I created those notes, the note buyers started calling me, and they wanted to buy my notes. And I sold all 25 of those notes and cleared about $420,000. So I was a don't-wanter landlord, and in less than a year's time, I had $500,000 in the bank. And then I learned the words income tax. I learned them to the core. But anyway, so the problem I saw with being a landlord was, and feel free, Scott, to jump in. I'm going to include you more here. I got off in my own little world here, and I was just running. The problem with being a landlord is you never know if it's your money or not. As a landlord, if the money comes in 1 or 2 or 3 months in a row, you still don't know if you can spend it, because if the air conditioner breaks, apparently you've collected the money for the air conditioner man, because it's not your money, because it's going to all go to the air conditioner man or the hot water heater guy or the window guy or the rehab or the make-ready person for the next thing. It's not your money, and you never know when it is, really. Mm-hmm. But when you're the bank and the money comes in and the check cashes and it goes in your account, bingo, it's your money from that minute forward. There's nothing to call it back out of your account except you and your vacation time and nice dinners with your wife. So, obviously, the maintenance when you're a landlord, it's your problem. When you're an owner financier, it's not your problem. Taxes, not your problem. Insurance, it's their problem. Liability insurance, you don't need it as a bank. You don't need insurance on the property, a liability insurance, but you do need it as a landlord. The entry fee, the difference between what it takes to get into a rent house and an owner finance house is night and day. Here's a question for you, Scott. What's the average kind of deposit on a rental?
What is it, first and last month?
Yeah, let's say the house is $1,000 a month for easy number. So you get the first month, and then you get a deposit equal to the first month. If you say first and last month, you'll never get paid the last month. So,
right.
So it's first month and a deposit equal to the first month. So on a $1,000 rent, that's $2,000. You really only have $1,000 protecting you and the damages on your house, because that other $1,000 that you got up front, that was for the month's rent. It wasn't, for anything else. So when I'm selling houses, $100,000. The houses I sell in San Antonio average sales price, owner finance, $80,000 to $100,000. I'm a pro, so don't get confused here. Don't set your expectations too high right off the bat. But I'm a pro. I'm using softwares like LiveCom. I'm getting $10,000 to $12,000 a down payment. When was the last time you had a $100,000 house that was a rental that you got a $12,000 non-refundable rent deposit? Like never.
Not going to happen.
Yeah, it's not going to happen. Well, I've had people give me on those $100,000 houses $10,000 down, $15,000 down. I had one the other day gave me $30,000 down. Said he wanted to pay off the house fast. That I don't even have that opportunity, not even a chance to get that done in a rental. In the owner finance game, because of I'm selling on down payment, which could be any amount of number that you and the seller want to do, I have the chance to hit a home run now and then that even pays for the house. That $30,000 that guy gave me down almost paid my house off. So now you want to talk about appreciation and depreciation, which is the big argument for the landlording side of the coin. We're going to revisit that in a minute. Anything else you see on here, Scott?
No, not on this slide. But I did have a question come in saying, obviously, if you're lending money and you're holding the first position, a question came in and says, wouldn't real estate taxes though still be your problem as a tax lien could affect your title? And just curious if you require escrow for real estate taxes in your seller financing. Again, if this is something we're going to talk about later, we can push that question off. But that did come up.
Dodd-Frank, it's against the law to collect it and not collect the taxes of the insurance. You have to escrow. It's not your choice. You have to collect principal, interest, taxes, and insurance by law. And I actually collect an escrow servicing fee on top of that. So I collect, and then I have an escrow servicing company to handle it all. And I get the buyer to pay for it. Everybody knows what a real estate lien note. Do I need to go over this, Scott? I think everybody knows what a note is by now.
I don't think so. I think everyone here would knows what that is.
Okay. So owner financing is just when you take a down payment and you agree to collect payments over a period of time. Now, if you're borrowing money to buy the houses, that lender's in the first lien position. That's what I offer. And then when you sell it, the buyer of that house owes a note to me. He's in the second lien position. So it's called a wraparound mortgage. The occupant that's buying my house, that's living in my house, makes me a payment of $850, and then I have to make a payment of $350 to my lender. So the buyer's note wraps around the seller's note. It's called a wraparound mortgage. Perfectly legal in the state of Texas. I haven't found any states where it's really bad, except maybe Pennsylvania, but I don't know. The core belief of the owner financing business is that a person paying $1,000 rent would rather pay $1,000 to own. Some things you don't have to look up in a book or do any research on. That rings pretty true, right, Scott?
I would think so, yes.
Now, it's not 100%, but let's just take all the renters in your state or in your city, and let's figure that only 85% of them would rather own, or 80, or 83, or 79. Pick a number, and whatever you come out with is a lot of customers, a ton of customers, and you don't have very many people offering the product that I'm fixing to show you. Your number one asset as a real estate investor in any strategy is your asset to establish value. You have to know what the value of something is going to be before you buy it if you expect to buy it and exit and make a profit. And so what I'm about to show you is how we establish the owner finance value, which is a value very different than any other value. It's you know what a cap rate is, right? It's a rate of return based on the net operating income, right?
Right.
I'm selling my houses on a cap rate, and I'm using the rent to establish the income, in the potential income. So here we go. This is very important, and this is the difference And you have to believe that core belief that a man paying $1,000 would rather and is better off paying $1,000 to own. If you don't believe that from the tip of your toes to the tip of your head, then this strategy is not for you. But I've been doing it for 22 years, and I know it's true. And I know there's hundreds upon thousands, tens of thousands of people that would rather take that $1,000 and become the owner. And this is how we establish the owner finance value. Scott, I don't coin much, but I think I coined the OFV. So you take the rents. The rents are relatively easier to find than comps, sales comps. You don't have to be a part of MLS when you can find the rents. Even apartments across the street. Apartments are professional rent collectors. They're probably at the top of the market. And you can figure that a 3-bedroom, 2-bath apartment for $1,000, if you have a 3-bedroom, 2-bath house across the street with a front yard and a backyard and a garage, is probably worth more than whatever they're charging for rent over there across the street at the apartment. But anyways, this is the key number. You got to get this number right. What is the rent for a comparable property in the area? Then you take the rent and you subtract the monthly taxes and the monthly insurance. In this example, the taxes are $100 per month and the insurance is $50. So $1,000 minus $150 equals $850. That $850 represents how much this renter has to pay you for principal and interest. Now I got an engineer out there to figure out if we're dealing in houses between, $50 and $150,000. What's a multiplier I can use to figure out what this person can afford to borrow? And the multiplier is 115 if you're using the terms 10% and 30 years. So all these numbers are based on 10% and 30 years, and that multiplier is based on giving your buyer the terms 10% and 30 years. So if you take 850 and multiply it by 115, it comes out with $97,750. I don't deal in those kind of numbers. That's $98,000. That's what my eyes see, $98,000. Close enough. They can afford to borrow $98,000 at 10% interest for 30 years and have a payment of $850. By the time they add the taxes and insurance in, they're at $1,000. They're right back where they were at rent. You see how I'm backing into this?
Yes. Yep.
Okay. So if they can afford to finance $98,000, what is the sales price? I add 12% on top as an optimistic number for down payment. So $98,000 plus 12% is going to equal about $110,000. That's the owner finance value of this house if it's in fine repair. If it's not in good repair, then I subtract 50% of the estimated rehab cost. So rent minus taxes and insurance times 115 plus 12% minus 50% of the rehab equals the owner finance value, the OFV. Say it one more time. Rent minus the taxes minus the insurance times 115 plus 12% minus 50% of the estimated rehab equals the OFV. This is gray. It's not perfect, but guess what? I don't need an appraisal, and no one can come tell me if my price is justified or not because I'm giving the owner financing to people with subprime credit and a down payment. And I don't know how you tell me what my price is. I don't know how anyone can tell me what my price is. A lot of times the owner finance value is 10 or 15% above the market. But my customers don't have any other choices. And for me to take that kind of risk on them, I got to do it my way. And if they don't want to do it my way, then they have to go find some other place or stay a renter for the rest of their life. But the argument for them being, even if I've had real estate agents say, well, you're ripping these people off. I said, I'm ripping these people off? She says, yeah, you're selling them for $15,000 higher than the average price in this neighborhood. I said, well, I think I'm not ripping them off. I think the landlords are ripping them off. I mean, my payment's $850 from year one. My principal and interest payment will be $850 from year one to year 30. What will the rent be in 10 years from now, Scott, do you think? If the rents are $1,000 today, what do you think the rents will be in 10 years, Scott?
Yeah, they're most likely going to go up.
No, see, they all hem-haw around, but I make them give me a number. So, Scott, give me a number. If it's $1,000 today, what will the rents be in 10 years? You got to have a number.
Yeah, it could be $1,500 or $2,000 depending on the market.
Right? What will it be 20 years from now?
That's even higher.
Yeah. What about 30 years from now? Mr. Realtor, my payment's still going to be $850, and at 30 years, they're not going to have a payment anymore. What's the landlord going to give this guy after 30 years? Nothing. Well, what is he? So I argue that to move from 1,000 rent to 1,000 ownership, even if the cost of the house is not exactly the representative of the comparable sales. I mean, those comparable sales are based on people that can get a new loan and pay the owner off right now, and that's not who I'm selling to. They can't do it. So that's my argument for that objection, and I don't get much rebuttal from it. These people also have the right to pay early and pay down or pay off, or if they just make one extra payment of $850 a year, they're down to like 17 and a half years. So, but here's the main thing. That's the owner finance value. It is not the MAA appraiser's value. It's not a current market analysis done by comparable sales. It's not done with a broker's professional opinion, which is dealing with comparable sales. This has nothing to do with comparable sales. It has everything to do with what is the rent. What is this man having to pay to live in this house every day for him and his family to live there? What do they have to pay? And I'm backing into that number to establish an owner finance value. And you've got to pick your words carefully when you're speaking to private lenders or when you're speaking to sellers or real estate agents. The owner finance value is $110,000. Don't say the value because you'll get yourself in an argument.
Hey, Mitch, we had another question come up. I think it'd be a good one to maybe address. We're talking a little bit about what you were just mentioning. But someone said if you find a property in an area where you can get the house for $100,000, but it will likely be $150,000 in 5 years, the question from this individual is it best to be the landlord to get that uptick in gain rather than the mortgage holder? I know this is obviously a lot of what your presentation is based on, but maybe just respond to that question on why you would forego that.
I guess it depends. If I get $50,000 in a down payment, am I better off waiting for the $50,000 for 5 years, or am I good to go right now?
Right.
Everything depends. I can understand, like in California, where prices of houses are going up 25 and 30% a year. I can almost start to understand being a landlord, but I couldn't understand being a landlord at any increase in California because you don't even have any rights in your house there. Mm-hmm. So, it depends. What if I only got $20,000 down? Is it worth waiting 5 years? What I'm going to make? Say I'm going to make on that house. I'll make at least. I average $535 a month positive cash flow. So in 3 years I've collected. Just make it 500 for easy math. In 5 years I'll have collected $25,000 plus $20,000 down. I get my money a lot faster than the rental situation because the down payment can make an awful lot of difference to offset the argument that you have here that the house is going to go up $50,000 in 5 years. It may go up, it may go up $50,000 in 5 years. What if your renter moves out and causes you $15,000 worth of damage? What if the renter doesn't pay you and gets you in a lawsuit and ties you up for 2 years and doesn't pay you and then costs you $15,000 when he moves out and steals everything? What about that? This assumption, 150, it goes up to 150 in 5 years, is the assumption that you didn't have any bills and that you was a perfect system for 5 years and you didn't spend a dime. And that's just ridiculous, I think. You agree, Scott? You see what I'm saying?
Well, yeah. And again, I think it's the philosophy and what you're looking to do. Obviously, I think what you said certainly makes sense. And if you think it's going to go from 100 to 200 in 5 years, maybe you do have a little bit different scenario depending on how much you can get. But obviously that's all relative.
But 100 to 150 would only be good in my eyes if I had no expenses during that time. Otherwise I want to do the owner finance because I'll get a lot of my money for sure within the next. I'll get a big chunk of it, at least 25% of it right when I sell the house. So and then $500 a month positive income for 5 years is 60 payments times 500 is $30,000, right?
Mm-hmm.
Yeah. So and it's their house and they're taking care of it, and I'm guaranteed that I'm not going to have to pay anything unless I have to foreclose. But a person that gives me $10,000 or $15,000 or $20,000 down, not likely to get foreclosed on, and the chances are I am going to collect my payments for the first 5 years, and chances are I'm not going to have one penny of expense, not one penny. You can't say that as a landlord. The chances are I won't have one penny of expense in 5 years. I don't think that. That just doesn't seem right to me. So I'm just pointing it out. I'm not saying you can't make money holding properties, but I'm just pointing out the other side of the coin. Rentals really look good on paper. Where they don't look good is in real life. The rental prospect says, okay, you're going to have a guy move out, and he's going to steal your washer and dryer and all your ceiling fans, and he's going to kick holes in the walls because he didn't pay me the last 5 months' rent, and I had a sheriff come out and evict him. I never see that in someone's rental plan, but I see it happening at the courthouse every day. It's happening at the courthouse every day, but I never see it in the rental plan.
Yeah, and again, that's why we brought you on. I appreciate you sharing all this, because that's, so some of you that are listening, you may hear that and say, you know what, I still want to be a landlord, and that's your prerogative. It's just, that's why we brought Mitch in today to really to share that other, like you said, the other side of the coin and give you a different perspective. So really appreciate it. But you want to continue on, go right ahead.
No, and please do not misinterpret my passion as arrogance or anything, or you know what I mean. It's not that. It's just I'm very passionate about this because I lived it for so long, and now that I'm on the other side of the fence and I'm the bank and not the landlord, my gosh, I can have 10 houses or I can have 150 houses. Nothing. I don't get any phone calls. I just get my checks. I can go out and buy a heck of a lot more houses or invest in a lot of other things, instead of being a landlord. So anyways, the two things you got to believe is that renters would rather own, and that if you happen to have to foreclose on somebody for some reason, that there's a ready and willing line of other renters that want to take their place. Now get this. My favorite strategy in the whole wide world, figure this out in your IRA or your 401k. Buy it, don't fix it, owner finance it for double, and watch the guy who's making payments to your IRA go over budget fixing up your IRA's collateral. That's the favorite plan in the whole wide world. Buy it, don't fix it, and owner finance it for about double. If you buy a house for I'm going to use really easy numbers here. You buy a house for $25,000 and you got to put $25,000 in it. You got $100 and you got $50 in it now, and you got to sell it for $100. You double your money. Well, if you buy it for $25 and you just owner finance it for $50, you doubled your money too, but you didn't have the risk of a rehab, because that's where you always lose the money. You heard the saying, Scott, you make your money when you buy?
Yep, yes, sir.
Yeah, well, here's the tagline that Mitch and Stephen, this might be the second thing I invented, the tagline to that bumper sticker that says, you make your money when you buy and you lose it in the rehab. Isn't that where you lose the money?
I think so. That's what you see. Yep, on all the shows on TV, that's where not many shows they show on TV rehabbing where they stayed under budget. None,
and I always ask my audience, hey, how many of y'all done rehabs? They raise their hands. I said, how many of y'all have ever gone over budget? And if someone's not raising their hand, I said, well, either you only had to replace a piece of carpet or something, or you didn't have a very big rehab, or you're just not telling the truth. Because I'm a professional for 22 years. I go over budget on the rehab every single time. And it's not because I'm dumb. It's just the nature of the business. Between the theft and the overages and the surprises that you find, and then your own emotional, I feel like granite today. I don't know why, but I'm going to go over budget, but put in granite. I just really want granite in this house. You just go over. It's so much nicer to watch the owner that owes you payments every month to go over budget. And no one asked the obvious question. In my formula, the owner finance value, where I only minus 50% of the rehab, why did I only take 50% of the rehab cost off the price? Why didn't if the rehab's $20,000, why am I only subtracting $10,000 when I offer this price for sale for the rehab? You know why, Scott?
Go ahead.
Because I tell everybody it's $20,000 to rehab this house, and they consistently, 100% of the time, argue with me. No, I can get it done for much less than that. I said, well, how much can you get it done? They're always about half. I can get it done for 10. I finally figured out they're not counting their labor. So if they're not going to count it, I'm not going to count it. And it's great. If you find someone that really wants to fix the house, and, you may have to add a little bit to that. It's great. But I start off my price with only subtracting 50% of the rehab, because if I find a do-it-yourselfer, it's going to be right in line with what he's thinking.
Yeah, Mitch, we did have another question pop up again, and you had the formula up there a minute ago. Just you kind of quickly covered how you arrived at that 115 figure as your multiplier.
I hired an engineer to tell me what do I need to multiply by to end up with the same kind of numbers that I'm going to have if I got out an amortization table.
Okay.
Because here's the thing. In my entire career, 1,500 houses plus or minus in 22 years, I've never had a financial calculator in my life. I have a $3 solar-powered calculator that I bought at the dollar store, if that makes any sense. And I hold it up to the sun, and it gets a charge, and I do cash-on-cash calculations, and I use my multipliers, so I don't have to have a financial calculator. They're not perfect numbers, but they're close enough. They're close enough when you're dealing in houses between 50 and 150,000. That 115 multiplier. So you can do this in your car in less than 10 minutes. You don't have to whip out an amortization schedule and go through all those hoops. I need to do things fast, and so that's how come I use that multiplier. And I was not smart enough to figure it out myself. But if you get an amortization schedule and look up $98,000 or $97,750 at 10% for 30 years, and 10%, 30 years, $850 payment, and solve for the balance, you're going to be real close to $98,000.
Okay.
So here's the thing: the buy it, don't fix it strategy. Imagine if you could buy a house today and owner finance it tomorrow, and you could owner finance it with a hole in the roof the size of a kitchen table. Tomorrow you could do it. You could buy it today for $25,000 and owner finance it for $49,500 or $50,000. The next day you could put it up for sale. You'd save time. Your ROIs are higher when you use smaller numbers, because sometimes you can sell, instead of buying a house for $25,000 and selling it for $50,000, you can sell it for $55,000, because the extra $5,000 doesn't add that much to the payment because the numbers are so small. So your ROIs typically are higher when you don't have a lot of money in the place. It spreads your risk out, because if you only have $500,000 to buy houses, how many houses can you buy at $50,000 in them, like $25,000 for the purchase and $25,000 for the rehab? Or how many houses can you buy with $20,000? You can buy twice as many houses if you don't do the rehabs. So it spreads your risk, and it's easier to find private lenders on smaller amounts of money. What's easier, to find someone to buy a house for loan you $100,000 so that you can owner finance for $175,000, or find someone to give you $30,000 so you can owner finance something at $60,000? It's easier to find the $30,000. So here's a case study. The house on San Felipe. I didn't take pictures of the inside of this house, but I wish I would have, but I think I can paint the picture for you. There was no cabinets. There was no countertops. There was no carpet. You could see wood floors, concrete floors in some places. There was no ductwork. There was no sheetrock. There was no insulation. I could stand in any corner in this house and see the other three corners and all the studs that marked off where the rooms were supposed to be. That's what the inside of the house looked like. It was a shell. And I bought this house for $15,000. I always pay myself $2,000, so I borrowed $17,000 at 8% interest only for 5 years, and my monthly payment was $114. Now, I know some of you are in parts of the country where this seems like you can't even buy a car for this. This is kind of an anomaly, low, but I like to go with conservative, small, but they do multiply out. I mean, today, my average purchase price is around $45,000 to $65,000. Because I found that I had less turnover when I got into more expensive houses, a little more expensive. I sold the house for $38,000 in like one day. I was putting a sign in the yard, and the guy across the street came over and said, "I want that house." He said, "I can give you $3,000 down. I'll take it as is, and I'll fix it." This was the house I learned about the buy it, don't fix it. This was the house. And I said, okay, well, sounds good to me. I carried $35,000 at 10% for 12 years. I squeezed this one down to 12 years because the balance was so low that it wasn't worth collecting at a 30 years. So I squeezed it down to 12 years. He owed me $420. So my positive cash flow is $306. But you see where I picked up $5,000 up front and created a $306 a month positive cash flow, of which I am not a landlord. That's my money. So I got paid $5,000 to create that $306 cash flow. Why do I borrow $2,000 on every house? Would that be a good question, Scott?
Yes.
Well, because it cost me about $2,000 to find this house. I do about 100 houses a year. If I leave $2,000 worth of advertising and effort to find these houses, if I leave $2,000 in every house and I do 100 houses a year, how much did I leave laying around? $200,000. In 5 years, that's $1 million. Anybody got $1 million to leave laying around in 5 years? I don't. So you got to see, if you borrow from banks, though, they won't give you that $2,000. This is why private lenders are, again, one of my favorite staples. I buy all these houses with private money. 8% interest only, 5 years. And they never question it. I mean, it's hardly over-leveraging, you know. I sold the house for $38,000 and I borrowed an extra $2,000 and I got $17,000 in it. It's not over-leveraging. So then I collected 6 months worth of positive cash flow. So I collected $1,800, a little over $1,800, and the guy fixed the house up like this. And it had cabinets, carpet, sheetrock, texture, tubs, sinks, vanities, mirrors, lights, fixtures, ceiling fans. It had everything when it got done. He didn't put in central air. He put in the little window unit, but that's okay. He made this house worth $69,000, and heaven only knows what he spent in labor and materials. But I'm sure it was a lot, $15,000 at least. So here's the breakdown. I collected $2,000 when I bought the house. I collected $3,000 when I sold it that next week. I collected $1,800 plus for the next 6 months in the positive. It was a very short note, and he was paying down, and I sold the note for exactly what I owed because the house was now worth $69,000, and I sold the note for $30,576. So I collected $37,306, and I had to pay back the $17,000 that I owed, and I netted $20,306 in 6 months on a house that I bought under contract for $15,000. God bless America. Everybody's happy. My lender's happy. He made a good rate of return. The guy that bought the house and moved in he's still there today. That was a long time ago when that happened. And I got to make a living for my family, and everything's just hunky-dory. So the big question is, what's the rate of return, Scott? I don't have any money in this of my own, and I made $20,306 in 6 months. It's incalculable. I don't have an investment. I have zero of my own money in this. Now, there's lots of arguments here to be had, but let's just suffice to say that, I have time in it. And time is
right.
Some kind of money, but I don't know how to calculate it, But if you try to go, if someone says, well, what's your ROI? The first question that says, well, how much money of your money do you have in the deal? I don't have any. Notice I got paid 4 times. I got paid when I bought, when I sold, in cash flow every month, and then when I sold the note. Now, I don't advocate selling notes, but because if you do this right, you never have to sell a note, because why would you? But there's 6 ways to get paid, but we're not going to go into the other 2 ways right now. They're a little too complicated. So this works best in affordable houses. I'm going to change this a little bit because I'm finding out that it's still working in houses that I can retail for $130, $40, $50. Once you start getting to more expensive houses, you can still do it, but the rules change a little bit. I'm not going to get into that either right now because we don't have time, but suffice to say that once you get more expensive houses, the relationship between the rents and the mortgage starts to break down. It's hard to keep them equal, the rent versus the mortgage. It's hard to keep them equal. However, wealthy people want what they want, can put much more money down, and they'll pay extra to own a house if that's what they want. So that's where the fly in the ointment comes into the theory. When you get up into wealthier houses, wealthy people do what they want because they want and because they have the money. And so it kind of, in a way, doesn't have to be equal to rent anymore. It just has to be a desirable place. Now, here's something really, really interesting. And this was about the time I learned about the recession, where I learned about the buy it and don't fix it. I had 245 houses. And as the recession started to sneak into Texas, the first month I got a call from my office said, we got 15 houses we put in foreclosure this month. I said, okay. And I was off, to the next round of golf. And then the next month, another 15 houses. They called me and says, we've got about another 15 houses. We got 30 houses in foreclosure right now. And I started to get concerned, and I was trying to play golf, and I was playing golf, but I couldn't hit the ball to save my butt because I was, in the back of my mind, I was going, this isn't good. Next month, another 15. I jumped out of my golf cart while it was still driving. I let it drive right into the pond. I never looked back. I didn't pick up my clubs. I went right to the office. I rolled up my sleeves, and I started panicking. How long is this going to go? What's going to happen? Well, anybody who was borderline on the fence in my owner finance homes had fallen off on the wrong side. They had their hiccup. They couldn't recover. And this was also I was dealing in the really cheap houses. This is another lesson I learned was to move up in the grade of house just a little bit because people buying a little bit more expensive house can take a bump in the road. The ones at the very bottom, they hit one bump, they can't recover. You either have to forgive it and add it to the end of the note or foreclose on it, but they're not going to catch up. So that's when I learned to move up to a little bit nicer house, to a little bit more stable buyer. But here's what I really learned. I had 2 crews. Usually my crews are only good at one house at a time. I thought I'd stretch them and start, man, you've got to do 2 houses at a time now. I got 45 vacancies. Even that was daunting. 45 vacancies doing four rehabs at a time. I'm never going to get through them. I'm never going to get through those houses. So I came to the conclusion that I had to put up the other 41 houses as is for a price and see what happens because I couldn't just let them sit there, and I didn't have enough crews to remodel them. And the last thing I wanted to do was jump into 6 or 8 or 10 crews that I didn't know because that's a recipe for disaster. And so by the time I remodeled and sold those 4 houses, I had liquidated about 35 of my houses that were left in disrepair. I had sold them on notes as is. And that's when the light bulb went off in my head and said, oh, my God, what have I been doing all these years? I've been spending this money, getting my materials ripped off, getting ripped off by contractors, going over budget for nothing, all for nothing, and wasting all that time. And then I started to figure out that this business might be recession-proof. It's a really big statement. I'll never say it's recession-proof right out loud, boldly, but I say if there is such thing as a recession-proof business, the owner finance strategy might be one of those businesses. And this is why. In the recession, what happens? Either the cause of the recession or the direct reaction to a recession is the banks stop loaning. Can we agree on that, Scott? In 2009, one of the worst recessions, the banks flat stopped loaning money, didn't they?
No, I mean, from the different groups we're part of that we network with, that was the constant complaint. You couldn't get money anywhere.
Okay.
And some still having trouble now. It's not like it used to be.
Yeah, because they got burned and they're trying, but it's starting to come back. But so what happens to the price of houses when no one can borrow money to buy a house?
Goes down.
Yeah. So I was seeing houses in 2009 and 2008 going down to prices reminiscent of 15 years prior. There was houses that had 70% cash sales. You know what that does to the purchase price and the comps? It drives them down to the ground because no one in those neighborhoods could get a loan before the recession. And then they raised the credit score from 5 whatever to 680. Do you remember that?
Yep. Mm-hmm.
Which increased my buyer pool a lot. So if the prices of houses are going down, if no one can afford to buy houses because the banks aren't giving loans, what happens to the rents?
Oh, typically would go up a little bit.
If no one can buy houses, then they're renting houses, right? I mean, there's a certain amount that go under a bridge. We're not going to talk about that. We're talking about they're either buying or they're renting. If no one can buy, then they all become renters. That puts a lot of pressure on the rents, and the rents are going up. Scott, what is my sales price based on?
What the rent is.
Yes. In the recession, my owner finance houses prices were increasing. My prices were going up in the recession. I was buying at the low of the low because the banks weren't loaning and everything had to be dealt with in cash or private money. And I was selling without a bank, and I was selling at the rents, and the rents were going up. That used to be $1,000 a month rent house. Now it was $1,150 a month rent house because everybody wanted a rent house and there wasn't any. And so now I did my calculation based on $1,150 rent minus the taxes and insurance. My owner finance price was going up, no doubt about it. It goes against all rationale, and even my bankers from Harvard had to finally say, we've looked at your spreadsheets before and after, and you are appreciating in the middle of a recession. I said, I told you guys, I've been telling you that for like the last 6 months. You're not listening to me. And they finally believed me. So it was the recession was a perfect storm. So if you do pretty good in the good times, Scott, and you boom like crazy in the recession, when do you go broke?
Sounds like a good plan.
Well, I could find a way to screw up anything. So there are ways to do it. Now, I didn't do this because I had learned lessons from previous recession and from previous life experiences. But how you would mess this up is 3 things. 1, don't have integrity, because lawsuits will break you. And if you don't have integrity with the people that you're selling your houses to, you're going to get in lawsuits, and that'll kill you. It doesn't matter what time of year it is. Number 2, you got to conform to some federal and state regulations and laws. You don't do that, you could get hurt pretty bad, if not devastated. And number 3, you can't over leverage. I never borrow more than 65% of the owner finance value, and I police myself. If I want to pay $70,000 for something because it's in a hot market and I know I can sell it in 8 days and make clear $25,000, then if I want to pay $70,000 for a $100,000 house, then I got to put the other $5,000 in out of my pocket. I never let my private lenders in over 65% of what that owner finance value tells me I can sell my house for, and I average 58%. So think about this: if everyone in Bernie Madoff's pyramid scheme would have had a $100,000 house for every 55, 60, 65,000 they had with him, not one of them would be broke today. Not one. In fact, most of them will be much wealthier than when they went in with it. I'll say it again. If everyone in Bernie Madoff's pyramid scheme would have had a $100,000 house as collateral for every 55, 60, 65,000 they had with him, none of them would be broke. And that's what I offer my private lenders as a first lien position on my house. They either get paid or they get my house. In fact, I have the right to do either one any day of my life. I have the right to pay the interest we agreed on, or I have the right to hand you the deed to the house. And if you don't like the house, don't do it. Now, that being said, 1,500 houses in 22 years, I've never given a house back in my life. Never been foreclosed on, never filed bankruptcy, never been late on I say late. There's been some things that fall in a crack or something happens, but I've never missed. My people are extremely happy, and I've had them for 20, 15, 20. I've got references a mile long. And it's funny what happens when you make agreements with people, give them the documentation they're supposed to have, that they're really documented down at the courthouse. They really have a first lien and the title company acknowledges it, and everything's down the line, and you pay on time. That's why I have $12 million of private people's money, because for 22 years I never missed. Knock on wood. It'll take something cataclysmic because there's too much money in this business, and I've learned too much about it to screw it up these days.
Hey, Mitch, before you go, I do want to ask one. We had a couple people have asked questions about, and obviously you paying back your private lender is one scenario, but you have the homeowner that's paying back. People have asked me questions to talk a little bit about the foreclosure process. I mean, when I'm sure it's happened. I mean, obviously, the more people put down, the less likely it is to happen. But obviously, at times, you're going to have people that, for whatever reasons, can't make their payments. So you have to foreclose. Kind of maybe talk a little bit about that, if you can. What the cost is, how long it takes the property to get back, or do you have strategies to mitigate that?
Okay, first of all, there's no perfect plan, and of course, there's going to be foreclosures. If you're trying to, there's no perfect plan. Just like those people that are advocating rents. You're going to have a $400 a month positive income. Yeah, if it goes perfect, you will, but nothing's perfect. And so neither is my business. I have some foreclosure rates. Let me tell you how hard a foreclosure is. I got a foreclosure attorney, and when someone doesn't pay me and it gets to be 60 days, I pick up the phone and I dial his number and I give him the address and I tell him, call me when we have the keys, and then I hang up. That's how hard a foreclosure is. And I pay him $800, and it takes about, in Texas, The fastest it could go is about 46 days, but nothing's perfect, and you never hit the right timing. It's usually around 70 days to, 60, 90 days, this is usually what it takes, depending. And if they want to file bankruptcy or whatever, then you could be in for a year. But that's just the cost of doing business, and it doesn't happen very often. It's different in different states. Now, every state foreclosure process is different. So I'm talking about Texas. So, okay.
Right. So yeah, and someone brought that point up too, just in the comments too. Yeah, definitely the other states might have different rules, and I think that what is, I guess, somebody asked a question. So what is the biggest gotcha or that people need to be aware of, or what mistake that they can learn from? I think before you get into that question, obviously one of the answers to help avoid foreclosure is larger down payments if you can get them or require them. Is make people less likely to walk away from a property.
Yeah, but that's not the end of it. Just because someone has a large down payment, it's not the end of it. I want to know where you got it. Was it a gift? Can you explain to me where you got it? Are you selling drugs? I can look at most of them and tell you if they're selling drugs. They got the teardrop tattooed in the right eye, and they got their girlfriend's name on their neck, and they're showing up with $30,000. That guy's not getting my house. I'm not going to try to collect money from a drug dealer. Other things are if they're gifts, and then background checks. How does this person live their life? And then credit checks. I understand they're not going to have perfect credit, but what caused their imperfect credit, and how are they getting over it? Or are they right in the middle of their debacle right now, and I'm just the next guy they're not going to pay? I understand there's good people that have had bad things happen, but I need to know they're recovering, that they're not still in the middle of it. There's a lot of gotchas. I mean, that's one of the reasons why I'd say you're either going to pay the street or you're going to pay a guy that's done 1,000 of these deals to keep you out of the mud. I mean, honestly, you're going to pay the street or you're going to pay someone who's done 1,000 of them to help you avoid the pitfalls. Either way. It's a lot less stressful to have a coach and go with confidence and have a plan, but I learned from the streets. I tell everyone, Scott, I graduated from La Calle U. How's your Spanish? La Calle means the street. Some people get it, and some people think, oh, he's a college grad. Okay, so why is this business recession-proof? This is very, very important. It's because I eliminated banks. I didn't need banks to buy the houses, so when the banks climbed up and the prices of houses were falling like a rock, I could buy all the houses I wanted to. In 2009, I was buying a house a day for 40 days in a row, and I scared myself and stopped. I bought 40 houses. I was one a day for 40 days, and I scared myself. And then I didn't need a bank on the other end when I was selling. I was financing the house. I didn't need a bank on either end. When the recession hit, most people's strategy needed a bank in the front or on the back. I didn't need one on either end, and I was the only guy open for business. Me and a few people, a few very strong, sturdy people that understood this concept, which was not many. I don't know that any of them really got a hold of it for a while until people like me started talking about it. But that's why this business, if it's recession-proof, is because it doesn't require a bank on either end. Most businesses can't say that. So here's another quick study. We'll go through this kind of fast because I know we got time here. This house had a heaving foundation. If you dropped a bowling ball in the middle of this living room, I couldn't tell you which way it was going to roll, but when it hit the wall, it was going to put a hole in it. I bought it for $38,000. I paid my bird dog $1,000. Paid myself $2,000. I had $41,000 that I borrowed 100% of my cost. It was 8% interest only. My payment was $273 a month. I sold it for $65,000, and the guy put $6,000 down. I carried $59,000 at 11% for 15 years. This was right before the Dodd-Frank, and oh no, this guy wasn't going to live in it, so Dodd-Frank didn't apply. This was a commercial loan. He lived across the street in the house, and he wanted that house. And he bought it, and he put his family member in as a renter. So I didn't have to comply with Dodd-Frank. I was able to charge 11% for 15 years. He owed me $670, and the total cash flow was $437. You see where I made $8,000 to create a $437 amount positive? Now, this one, too, I'm going to play out. I sold the note in 6 months. This guy made the house worth $110,000. Okay, so down here at the bottom in the green, I paid $2,000 when I bought the house, $6,000 in the down payment. I collected $2,600 in cash flow. I sold the note and paid back my investor and made $18,000 profit when I did that. I collected $28,622 on this house in less than 6 months, and I paid, $41,000 for it. So, but I was suggesting the IRA, you buy these houses, a lot of people buy them for cash. You don't want to sell the note. Just collect the 10% on $59,000, knowing that you only got $41,000 invested. The ROI on that's got to be incredibly crazy. You're getting 11% on the face of the $59,000, but you only paid $41,000 to get in that position. I mean, there's got to be like a 20-something% rate of return.
Yeah, and that's something I've talked about other seminars we've done too, and we've discussed that. When you're buying at a good price and you're owner financing for a higher price and end up holding the mortgage, you're buying a discounted note almost up front. By the time you get through it, you pay $40,000 for a property and you end up with a $70,000 note. You've already created some wealth for yourself just right there.
Anyways, you could figure out the ROI. You'd multiply 437 times 12 plus, I don't even know how you figure the down payments and all that stuff. It's really hard to figure it out. Well, what you do is I don't know. There's too many ways to look at it. So but the ROI is incredible. So, and this is how I get a house free and clear about every 10th house. Sometimes I get really lucky, and I'll buy a $50,000 house for $20,000. I'll buy a house that I can owner finance for $100,000. I'll buy it for $30,000. Every now and then I get lucky. I still borrow, $55,000, and I take the overage that I got at closing, and I put it in my FHA account. That's my free house account, and I just put it over in my FHA account. And then every deal I do, like maybe I buy a house for the next one for $45,000, and I could have paid up to $50,000. I still borrow the $50,000. I put $5,000 in the FHA account, and over a period of months or deals, I look up and I see a house I can buy for $50,000 cash, and I look at my FHA account and go, guess what? There's $53,000 in that account. I'm just going to stroke a check for this house now. So I always the secret is not to over leverage, not to borrow over 65% of the owner finance value. So if you buy a house for $50,000, you could potentially borrow $15,000 above, not $2,000 above, $15,000 above. You're still at 65% loan to value. It's still a protected position. I don't like to borrow up to 65% in the name of putting money in that free house account. I like to stay around 58, 55%. So if I buy a house under 55% of the owner finance value, I will borrow up to 55%. I think that's an incredible safe place for my private lender to loan me 55% of what I could owner finance it for. I think that's incredibly safe and incredibly responsible on my part. And if there's room to borrow some extra cash and put in my free house account at 55% loan to owner finance value, then I will. I can't tell you how many houses I have free and clear because of that. The key to this is raising private money. Maybe in your side of it, if you have IRAs or 401ks, people just have cash that they want to get out in places, and they're just paying cash for these houses. I understand that in the IRA. I don't understand it if you're a person starting from scratch and wanting to build a career or build your freedom. You're going to have to use the leverage of borrowed money. Borrowing $60,000 on a $100,000 house at 8%. By the way, my loans are non-recourse, collateral only. So, like I said before, they either get paid the interest rate or I have the right to give them a deed. Either way, that's the end of the story. And so raising private money is key. The difference between making a good living in this business and being a multi-millionaire is private money. I have $12 million of private money. I can walk around this town. I can't spend it all. And I can point, I want that one, I want those two, I want these three, and it never ends. And I can buy as many good deals as I want to buy, and I don't have to shy away from it. 1 month we bought 18 houses in 1 month. My daughter calls me and says, we have a problem. I said, what? She goes, we got 18 houses and we got to close in 12 days. I said, what's the problem? She said, it's $1.3 million. I said, what's the problem? She says, you can come up with $1.3 million in 12 days? I dropped everybody to the office. I made 6 phone calls in less than 20 minutes, and we were done. That was it. And we bought the houses, and my office learned to not slow down.
Well, Mitch, that was a question I think on the last slide you had too. Someone said, "How did you find money? How do you find the private money?" I mean, somebody said, "How did you first find it?" But obviously, over time, you build up relationships with individuals.
Okay, well, here's the problem. This is a really big key, and this is like when I'm coaching people, if all I do in a year is teach someone how to raise private money, you can't put a price on that. You can't put a price on how valuable that is. I charge people $15,000 for a year to be with them and to talk to them whenever they want to call me. But if I only teach you how to raise $50,000 that year, and that's the only thing that you get done, then that's been way worth it, because with $50,000 you can do that over and over and over again, making $20,000, $30,000 a pop, or at least $10,000 a pop, over and over and over again with that one person's private money. Here's the problem. Everyone has this mental block, and that's what I really do is I don't help people do anything more than get out of their own way. I had one of my best students was 25 years old, and his mental block was everyone I'm talking to with money, in their late 60s, mid-70s, early 80s, they're millionaires. Why in the hell would they loan a 25-year-old kid that's new in this business any money? And he couldn't get over it, and it was showing up in his presentation. In fact, he was embarrassed to even ask anybody, because that's what his sticking point was. All the other excuses are like, I have a bankruptcy. I don't have any experience. I'm not good at talking to people. I don't know people with money. I'm too tall. I'm too skinny. Here's the deal. It's not about you. It's about the deal. If you don't pay them, what are they going to get? I mean, Charles Manson should have been able to get private money. If he could find a $100,000 house for $50,000, he should be able to get the $50,000 from behind bars, and he should have been able to get it from the warden. You just say, "Hey, warden, I need you. This is Charles Manson yelling at you from down the hall. I need $50,000 loan. Will you loan me $50,000?" The warden yells back, "Manson, I know you've lost your marbles now." And then Manson yells back to the warden, "Hey, I'm going to give you a $100,000 house that's free and clear as collateral. And if I don't pay you, you're going to get my house." The next thing the warden says is, "Guards, get Manson out of that cell and bring him down here. Just don't give him a pen till I tell you to." It's not about you. It's about the deal. And as soon as you get over yourself and take yourself out of the equation, what you need to do is be a great deal finder. When you don't have money, you become a master deal writer-upper. Is that a word, Scott? Writer-upper? You write up great deals, and then you take those deals to people with money and go, "Hey, you want a piece of this? Good. Bring the money. I got the deal. You bring the money. We're in business." They can loan you the money, or they become your 50-50 partner. Usually at that point, you're 50-50 partners with these guys. And that's the most expensive money in the world. Could also be the best lesson you ever had in your life. If the person that you're borrowing the money from has done 1,000 houses, you're probably going to stay out of trouble and learn a lot from the guy besides get 50% of a deal. It's longer stories. But raising private money is mental, and it's not about you. It's the only thing you have to do is present, present, present. I'll challenge you to talk to 25 people the way that I would teach you to talk to them about your deals. I would challenge you to get 25 no's in a row. I bet you cannot do it. So it's a numbers game. For one, to find people that are open or that want to talk to you, you have to say your elevator pitch to someone every day of the week, except for maybe Saturday and Sunday. So 5 days a week. How do you get people to ask you what you do? You ask them what they do. "Hey, what do you do for a living?" "Oh, that's great. I don't need that service, but I think I know someone down the street from me that does. Can I have your card? I'm in control now. I have the card." Eventually, then you just be quiet. And eventually, he'll turn to you and say, "So what do you do for a living?" And I say, "I help average people achieve above average rates of return, and I give them very valuable Texas real estate as collateral." And then we see how they respond. And I have the card. I can call to ask them for an appointment anytime I want to. But I challenge anybody to study my steps or study how I go about raising this private money, and I challenge you to understand that and be able to, once you understand it and can do the presentation, I challenge you to go to 25 people and get 25 no's in a row. I don't think you can do it. I have vast experience with self-directed IRAs and real estate experience. I've done a lot in my IRAs and my 401ks. They're tremendous assets to have. If you don't have one, you need to get one. Even just open one and then figure out what to do with it later. But, wouldn't it be a tragedy if the laws or the rules or something changed and you missed that boat? Because they are tremendous wealth-building assets to have, these IRAs. Tremendous. So are there any more questions or anything out there? I hope I did a good job in this. I don't know what my time is looking at, but...
No, it's fine. Most people are still listening, so it's been great. We did have a couple questions, though. We are running out of time. I'm going to get to just a couple of them that popped up. And as you mentioned, obviously, doing some of these deals inside an IRA is great because you have no tax consequence to those IRAs, especially the Roth IRA ever. But somebody was asking, the question is how much are you paying in taxes on your income? But I guess, obviously don't divulge that. But if you're not using IRA funds, what other strategies do you use to avoid some of the taxes on the income from those deals that you're doing?
Well, first of all, I live out of my companies. My company, I don't own a car. I don't own a phone. My wife doesn't own a phone. She doesn't own a car. My daughters don't own phones. They don't own a car. Right there is a heck of an expense. I don't care who owns it. We just need to use them. And, we got to be fair. You got to deduct a certain amount of mileages for whatever use. And, there's a lot of gray in this area. But when you own a business or you own an LLC or a corporation, you need to have some tax consultants and some tax advisors that know how to minimize your taxes. That's one of the things that that I have trouble explaining to my ex-attorney who didn't appreciate that I didn't pay much taxes. I said, look at it like I'm a commission salesman. I don't know why this is so hard for you to understand. He was mad at me because I lived a really great life and I didn't pay that much taxes. And I said, you got to look at it like I'm a commission salesman. The government will give me a break if I cause so much taxation. They'll give me a break on my taxes. Do you know how much taxation I cause when I buy and sell houses and fix houses? Do you know how much product I cause to be moved? How many people have to pay tax because I paid them? I cause so much taxation that the government gives me a break because I'm a great salesman for them, for lack of better words. I cause more taxation than I could ever pay. So that's the theory behind capitalism and don't overtax business, is that businesses cause more taxation than they could ever pay. And so it doesn't matter if you get a C Corp or an LLC, you learn the rules of the game and you win. Period. People say, well, what's better, a corporation or I don't know, pick one. Talk to a few people, pick one, and then learn the rules of the one that you pick and win. Play the write-off game, play the depreciation game, play the postpone tax-free 31 exchange game, postpone your taxes, postpone your taxes, postpone your taxes, and then die. Good job. Postpone, 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 die. Great job, my friend. You've done well.
Yep. In a couple of your examples, obviously the little examples you showed, you actually sold your notes. The owner finance notes that you created. You end up selling that note to someone else. Someone asked, who buys those? Do you have, again, is it the same kind of thing when trying to develop relationships with people that you are borrowing from, also developing relationships with people who will take your notes or buy the notes from you at a later date?
Yeah, I don't sell notes anymore. You shouldn't have to. Once you've got more coming in monthly from your positive cash flow than you need, why in the world would you ever sell a note? But in the early stages, a lot of my students and people need to sell notes for a variety of reasons. One of the most popular reasons that they need to sell notes is they have a naysayer spouse. So we have to sell some notes to get what I call some hush money in the bank, where the goal is to get whatever your complaining spouse makes per year, put that in the bank, and then tell them to hush up so that we can get going on and do this the way we're supposed to. But I don't discount my notes when I sell them. I do not sell to institutions because they demand discounts. I sell my notes to private people whom 8% is not aggressive enough for them. they want a higher rate of return. But most people that want higher rates of return understand the risk-reward quotient. And I say, well, I have ways that you could make a couple of percent more, or even, 3% more. But you'll be at a higher risk, because when you're making 8% with me, and I owe you $55,000 on a $100,000 house, that's not a lot of risk. Now, if you want to buy my note and make 11% or 10%, then you got to pay me, somewhere closer to the note values. And so you might be $88,000 into that same house,
Mm-hmm.
So I can get you. So what you do is you pitch for the 6 and the 8% money, and if that's not aggressive enough, then you come back around at a later date and say, I've been thinking about it, and I think I know how I can get you a higher rate of return. Would you be interested in buying my notes? But that's always second after you offer the 8%. For in the more protected position, because we really need we need the 8% to buy the houses. Nothing happens until we buy houses, so we got to solve the acquisition money first. After that, every other problem is just a luxury.
All right. Well, Mitch, I want to thank you very much for your time today and sharing your wisdom and your knowledge with everybody that again logged in live today, and also those of you who are listening to the recorded version that we have. I hope you've really enjoyed it. Mitch, just before we close, how can people get in touch? What's the best way for someone to get in touch with you if they have additional questions?
My website's 1000houses.com, 1000houses.com. My email address is mitch@1000houses.com. And if you just want to call and talk to somebody about, the coaching or whatever we offer, you can call 1-800-551-7807. 1-800-551-7807 and talk to Bo Cash. Believe it or not, his name is Bo Cash.
That's a nice name. All right. Well, Mitch, again, thank you very much for your time. I hope everybody got something out of it, and we look forward to talking with you again.
All right. One last thing, if you don't mind, I have my own podcast. I interview 2 people a week for the last, I don't know how many weeks, 250 interviews, archived in 2 a week, coming new at reinvestorsummit.com. reinvestorsummit.com. And if you're not tired of me already, you can hear more of me over there.
Sounds good. All right, Mitch, thanks again, everybody who's listening. Thank you for participating today, and we look forward to having you back on.
All right. Thank you, Scott.